Let's talk all things finance now with Dave McCarthy. How are you, Dave?
Very well, Ollie. Very well.
A couple of topics to get through.
Yes.
Let's start with the government introducing new legislation to protect homeowners where their mortgage has been sold to an overseas fund.
Yes, I actually covered this a few weeks ago with Keith, but I've had a number of questions since. Basically what happened here is that we've had a number of what are called vulture funds. These are overseas investment funds who buy loan books, come in, buy it at a discount, run the loan book, or else sell it off, or, in some cases force the borrower, if they're in difficulties, to sell it off, and then they make margin in it. The problem with this is that, and it's happened in a number of instances with the old Irish nationwide loan book, there were some mortgages with the old Anglo and a few others, was that when these institutions came in, they weren't covered by the Code of Conduct run by the central bank in relation to mortgage arrears. So basically you had an anomaly here where all the domestic lenders operating in Ireland were covered by this, which gave obviously the borrower protection, and these guys weren't. So anyway, the bottom line is that finally the government are bringing in legislation at the end of the year to extend that protection to everybody. So it's not your fault as to who owns your mortgage. You should be covered in the same way as somebody else who's a borrower at Bank of Ireland or AIB, and it's welcome. Basically what the legislation is going to state, because it can't be retrospective, is that all lenders within Ireland who have a loan book, irrespective of where they're based, will have to adhere to the Code of Conduct in relation to mortgage arrears and the protection that goes with it.
All right, now here's another question in from a listener. I've looked at a number of investments and they are all subject to dirt. Do you know of any others so I can reduce any tax I might pay if I make money?
Yes. First of all, most investments are subject to dirt, which is 41%, and you also have the PRSI, so effectively you lose half of the return. But in the last 6 months, a number of investments which are known as soft capital protection, these would have large elements of capital protection but not complete, have been introduced, which are very attractive, and they're subject to capital gains tax at 33%. So for argument's sake, if you had a situation where somebody makes 10,000 gain on something under dirt, they'll lose effectively nearly 5,000 of it. If it's capital gains tax, what they have to pay is 3,300 less an annual allowance of 1,270 that they're entitled to tax-free, which brings the tax down to 2,000. So there's a huge difference in terms of the taxation of both investments. So to answer that questioner's or that listener's question, yes, there are investments out there which are not subject to dirt.
Specifically though, what kind of investments would be dirt and what would be subject to capital gains?
Anything that has a full capital gain, capital protection is subject to dirt. But if you have some investments where your money is at risk, and this is outside of life assurance funds, right? They are subject to capital gains tax. These other ones, there's only a small number available at the moment. I think there's, off the top of my head, about 4 or 5 from a number of different investment firms. But they are very attractive, and yes, you could make a lot more than staying where you are at the moment.
Here's an interesting one. Recent research shows 50% of houses purchased are funded with cash.
Yes. No, I think this is really important, and I've spoken on this piece, as you know, a number of times, even last week, about the property market. But this is research that was done by PwC, where they compared the number of sales and they compared the number of mortgages drawn down in the last, 12 months, whatever. And what these figures show very clearly is that half of the houses that are being bought at the moment are being funded with cash. That's the first thing. Now, what does that mean? I think that's really important because it tells us two things in particular. First of all, the banks keep telling us that they are lending and they're giving mortgages. They are, but it's very limited. They're not providing enough capital to fuel the demand for mortgages. Their lending criteria is still far too tight. So they're not lending in a normal way. And this statistic proves it. They also came out within this research that the banks are lending at about half the level they should be normally. Okay, so that there is far greater demand out there for mortgages than they're willing to provide loans for. The second thing, which I think really it proves as well, is that you've heard, and it really irritates me, in the past few months, certain people coming out saying we're in a property bubble. That is rubbish. We're coming from an incredibly low level, and we still have pent-up demand from people who are renting at the moment, who want to get mortgages to buy their first house, and they can't find the finance. And despite what other people might say, this type of statistic proves that point. And the more people you get out of the rental market who want to buy their house, it'll drive rents down. And as we know, rents have gone to extraordinary levels because we have a lot of people trapped, if you like, in the rental market who really want to buy a house. So, whether or not this is the type of statistic the government and the banks want to listen to remains to be seen. But hopefully the government have said earlier in the year, and I've heard seen no more reports on this, that they were going to introduce a scheme whereby they would provide a guarantee effectively on a portion of the mortgage for the banks to encourage them to lend a bit more. But hopefully that'll come up between now and the end of the year. But that doesn't. I've seen nothing on that recently.
Okay. Having said that, I know Investec have been talking up the Irish recovery as well of late. So while you might put a little bit of a dampener on saying, okay, we're not exactly back to where we were 10 years ago or whatnot. I mean, there's no doubt there is recovery. The interest rate connected to government debt expected to decline further before the end of the year as well. So that surely has to be a positive as well.
It is, and I mean the employment figures are suggesting that we're going to hit below 10% unemployment next year. I mean, I was asked a very interesting question on this piece last week by a listener, and it was very valid. What effect does that have on me? I'm unemployed. And these are the people that really need to be looked after. The bottom line here is it trickles out into everybody. The potential for you to get a job when the economy is recovering and there's more positive sentiment, which there is at the moment. And by the way, just on that, again, I hate quoting statistics, but again, more research coming out in the last few days says that consumer sentiment is at a 7-year high. The last time we've seen consumer sentiment at the level it's at the moment was back in 2007. So again, for those who are unemployed this morning, maybe listening to this piece, all of this does have an effect, hopefully, on your potential to get a job down the road. A rising tide lifts all boats, that's a fact. And hopefully, as the construction sector begins to pick up more, and we've seen the number of houses that are needed in this country, which, by the way, is about 90,000 over the next 7 years, will help to fuel employment in that sector, which is badly needed.
Yes, we're thinking as well about students and the CEO courses coming out next Monday as well, and that those heading into construction now at least have a ray of light.
Yeah. I mean, look, it's not all, we're not out of the woods, there's no question of that, but we're certainly getting there with potential growth this year. I think it was something like 3.5%. It's stagnant in a lot of other Eurozone countries, and it's all getting there.
With that in mind, we see now that 40% of people are now saving on a regular basis. So this is probably one of the plus points to come out of the last couple of years.
Yeah, people have more disposable income now than they had. Now, certain people, obviously. And again, more people are saving on a regular basis than previously. And they also might feel more comfortable in saving as well because, again, there's a huge number of people, whether you're unemployed or employed, who are in negative equity. And we've seen a reasonable increase in property prices even here in Galway, which is beginning to, I suppose, psychologically help people to get over this kind of trapped fear that they have in their minds. Property prices still have a long way to go, but again, that's another effect, what we mentioned there about saving, of positive sentiment coming through and how people are feeling better about
it kind of ties into the piece we did with Charlie Weston at the start of the programme, Dave, as well, about, it's not just saving, actually keeping cash and not spending as much, but it's also, looking at bills and looking at ways and means of making sure that, okay, you don't necessarily need to have the full Sky package. Instead of paying 60 a month, cut back to the basics, get rid of the movies, get rid of the sports, and suddenly you're paying 27 a month, and there you have some extra money.
Yeah, we're a bit lax in this country about moving, and I mean, one of the probably the areas where it's even worse in relation to outside of the utility sector, people don't move their bank account. Despite the fact that there are other offers out there in terms of bank charges, they're very lax about moving their account, and they should be more proactive. But listen, look, it's good to see that people are informing themselves about their outlays. It's good to see that they are prepared to shop around, need to shop around more, and it's good to see that they're not just going to be led by whatever provider they're dealing with, whether it's a bank, a utility, or whoever. Saving money is what it's all about, and getting maybe a better service, and I think it's competition, as we know, It keeps everybody on their toes.
It's why the likes of the credit union movement has really mushroomed in the last few years as well, I suspect.
Exactly, and I mean, you know, in the radio sector, competition couldn't be greater. You know that firsthand. But it is good, and the only thing I would say is, and I would love to see in the future, is that maybe somebody like Ulster Bank would be taken over or merge with somebody and become a more proactive third force. And I know that their parent is conducting a review of the Ulster Bank structure at the moment, but we need far more competition in the banking sector.
Good stuff. Listen, Dave McCarthy, as ever, many thanks for joining.